If your upbringing was anything like mine, you probably think that investing is anytime you put money into something where you have the chance to make a return, because that was the extent of it for me. But there are three things that we absolutely have to know if we are going to be successful investors. And that's the difference between savings, investing, and speculating. And it might not sound like that big of a deal, but if you get these three things confused, you set yourself up to lose a lot of money. On the topic of not getting confused, please hit the like button so that YouTube knows exactly where to send these things. We're growing, we're stoked to be growing, and we just want this content to get out to as many people as possible. So hit it. So let's start at the beginning, which is savings. And it's funny, most of us know the definition of saving, but a lot of us forget the purpose. And so this is actually one of the most important parts of this whole piece is savings. Definition of savings. It's the amount of money we have left over after we spend, or the net surplus of funds, right? That's an easy one that's taught to us. The purpose of savings, though, is really for three things. One, for an emergency fund. Two, for opportunity cash. And three is short-term goals. All three of these components, we have to count on our money being there. So for savings, the most important element is the safety of your money. It's not putting your money at risk, because we can't have the value of our money fluctuating, because for all three of these components, we have to count on our money being there for all three. For savings, we put our money in a savings account. Some people put it in CDs, and we're making very little interest, but we are taking on no risk. So that's like the big thing to remember. No risk here, we need this money. One thing I get asked a lot though on social media is, what do I do if I have $10,000? Like, how do I get it invested? And they'll also follow with, it's just sitting there, it's kind of being eaten away by inflation, I need to do something. And the first question I ask is, are you in debt? Do you have your emergency fund set up? And I'm kind of generalizing a little bit, but most people say, I have a little bit of debt, or I have no debt, but yes, this covers my emergency fund. If that is the case, you should not be investing any of this money. It is okay that this money might be losing purchasing power due to inflation, because this money is living its purpose. We'll worry about the investing side next, but really focus on having the three components filled. Don't worry about return. This section is all no risk. If you want to make more than savings, this is where we get into investing. But it's really good to remember that they complement one another. It's not a zero-sum game. So with investing, it's typically a long-term process where you're buying an asset or assets. Probably the most common are stocks, bonds, mutual funds, ETFs, real estate. The real big thing to remember here, though, is this is where you're growing your money. So you're taking on more risk with the hope to make more return. But with investing, analysis and research are key. If you're a DIY person, you're basically going over different assets, sectors, trends, and trying to find out, any factor that is going to change the value of your shares. If you're not a DIY person, you typically have an advisor, you're using a robo-advisor that helps you build out your strategy. And it's going to be based on your risk tolerance and your capacity. And so it's kind of the idea of, if you have a low risk tolerance, you're not going to put dollars into more high risk investments, because your tolerance just doesn't handle that. So you'll put yourself in a less risk investment, but you are going to see less return because of it. The whole idea here is know what you're going out to do and have all of the research to support you achieving that goal. One thing to remember here, investing takes time. That's why we started the piece off talking about investing being done over a long period of time. Because using the stock market, for example, yes, since inception, it's seen a 10% averaged annual return, but that wasn't just smooth sailing the whole time. Looks like this. So when you're in it for the long term, you remove some of that short-term volatility. So over the long term, you are able to make that higher return. Now we are moving on to speculation or speculating. I already know we're going to get a lot of crap for this section, but it's where you're putting your money at a lot of risk to make a big return, typically over a short amount of time. lot of people refer to speculating as gambling, but pretty much the idea is I can win big or I can lose big. The most common speculation right now is crypto. And I know people give me crap when I kind of bundle the entire asset class into this one category, but I still think it's true. You remove all the altcoins, all these crap coins, and look at Bitcoin. Even the view of what Bitcoin is or is going to become is a store of value, right? This is going to be a place where it holds value of money. It's going to take a certain percentage of gold's market share. But that is the assumption because there's nothing saying that has to happen. So that is ultimately what you are betting on. Something very similar happened during the dot-com bubble. It was like the internet is the future. That was the selling point towards everybody buying in and investing was this has to happen. And so you had all these new investors coming in, driving up these valuations really rapidly. All of a sudden, the market crashed and wiped so many people out. So even though Bitcoin is, I would say, kind of the staple or one of these stable coins, there is still a speculation in that. One thing I often hear is, isn't there always risk in investments? So wouldn't that say that there's always a form of speculation? I'm going to give you two examples of investments I've made that I think show the difference between investing and speculating really well. So in real estate, when we're looking at a new project, we are going out and getting a ton of information that helps us build out our kind of financial model so that we can see performance, and then it also adjusts for any type of risks that we need to factor in on our investment. For example, we'll go out and do a market study so that we can find out what rents are in the area, what job growth looks like, who the major employers are, if the area is oversupplied, undersupplied, all of these metrics so that we can figure out what the opportunity is. One thing that we know is something unexpected might happen. So what does this project look like if there's a 15% rent correction, and is our project still viable? What happens if cap rates soften in our hold period? So if we're expecting to hold for 5 years, what if we can't sell it 5 years? What does this project look like in 10 years? So by doing all of this research and analysis, you are taking what would be a speculation with no information and turning it into a calculated investment decision. On the other hand, I started a company with two of my close friends, St. Archer, Josh and P-Rod, and even though we did due diligence to start the company, it was more of a speculation in what we were doing. We didn't know if people were going to buy our product. We didn't know if the marketing idea we had was going to work. We didn't know if the craft beer industry was really saturated like a lot of people thought. Was it a bubble that was going to burst? Were we going to manage the company well? We had never run a business before. Was there going to be a buyer? There was more speculation with St. Archer. So for our investors, yes, there was a higher chance that they were going to lose money. But on the flip side, we ended up selling the company and the return the investors made was insane. So I think that would be two good examples of the difference between investment and speculation. So this is the importance of this piece. You need to know the difference between all three components so that you know what dollars to place in your investment strategy. Savings, that money is meant to be there. Do not take risk. Investing, that is to grow. Speculation, that is more risk, but more return. My rule of thumb, when I'm speculating or making a bet, I am only putting money in that I'm totally comfortable losing. That money goes away, all good, doesn't affect me at all. My investments, I'm putting kind of the bigger bulk of my money in because I want it to grow, but that is only after my savings. Emergency fund, opportunity cash for when markets correct, and short-term goals. That is how I do it. It's been a pretty good strategy so far. So I hope that helps. If you have any friends out there who are speculating and they think they're investing, please send this video to them. This is an area where a lot of people get confused and a lot of people end up losing more money than they need to. So I think there's a lot of value in it. Please share this if you know anybody in that regard. A lot of people participate in crypto. Maybe they need to hear it. Just saying. I love you, crypto guys. Thank you for being here, and we'll see you guys next week.